All right, good morning, everybody. Another week. One of the things you want to watch out for this week is any kind of end to the conflict. It's very likely not going to end all at once. They're already way too deep into the conflict, and this has kind of been tied directly to the success of Putin himself as the leader of Russia. So if he fails in this endeavor, he's pretty much done, and he's been running that country after his re-election, because he was running it for a while, then he was defeated in an election, then he re-won and has been running things almost 2 decades, I think. This will be directly connected to whether or not he stays in power. And so there's been a lot of talk that he is not going to capitulate here. He's not going to back down, and he's going to continue to use whatever he needs to resolve this as a win. Still, any news that talks about a ceasefire or an end to the current conflict could cause a significant spike to the upside. So definitely want to be keeping your eye on that. I've seen a number of posts over the weekend that was talking about support and resistance and, performing technical analysis on the charts. It's really important to understand that even if you see a technical signal that says go long or go short, you still want to approach it with extreme caution. Generally speaking, when the S&P is underneath its 60-day moving average, then any new trades that you try to take long as a swing trade are very likely going to fail. Now, of course, that's not across the board. It's not a guarantee, because depending on the sector that you're trading in, it could work. Watching some of the analyst upgrades and analyst downgrades and revisions this morning, they're starting to back away a little bit from that cyclical money rotation. So just realize, even if your signal is there, is very likely going to fail. We don't want to be too heavily short, because any really good news on the war front is going to spike the market. You don't want to be over heavily long for the same reason, right? If the news gets worse, then we're going to see that move to the downside. Also, any strategy that uses a range-bound market like iron condors in a long duration, 2 months, 3 months, should be approached with any caution, since an iron condor is basically drawing a box around price and saying, I bet you won't leave this box. Looking at the size and the speed and the scope of the movements we've had in price, that strategy seems very hazardous and very dangerous. So just, approach with caution. The cyber warfare issue is still on the table. It's one of our biggest threats right now. If they, uh, begin to target us or Japan or the EU, then I think we're really going to see this market respond in a bad way, right? So just be careful. Keep your eye on the news. I've been using FXStreet. It's free. Um, it's a really good source for day-to-day information. Finance juice. Throughout the day, I have this up on one of my screens. And when the news is deemed really important, it shows up like that in a deep dark red. So it just really kind of stands out. That way I'm not sitting there trying to read, through every little bit of this all day long. It is something that you can configure. So if you just make a free account, go in and adjust the settings so that you can turn off things like uh, MSNBC and junk like that, kind of narrow it down to news that you deem relevant. Around the world, markets are negative. It got a lot worse when oil spiked up to 130. When we bring it over to Thinkorswim, go to Market Watch, calendar, you can see we have additional auctions today at 11:30. I can't stress it enough. Although these are not something that you often hear about in any of the news, right? Everybody always focuses on things like unemployment and job numbers. These additional auctions are game changers. They can completely reshift or reshape our day. Can't stress how many times I've seen the market turn on a dime right at 11:30 and just begin running like a mad demon or dropping like a brick in water. So watch the clock. Don't sleep on these. This is the difference between, getting in just a few minutes too early, getting stopped out, um, seeing a completely different afternoon in your market. We're still in a squeeze in the ES. Um, we're not ready to roll yet, but it's getting close. It's worth noting the open interest. Bring up the expected move for the week, and you can see how just absolutely extreme it is. Just to give you a little bit of context, this is the size of last week's expected move. This is the size of half of this week's expected move. Right? It doubled. That's how big the implied volatility is at the moment. It didn't go up a little bit, it doubled. Another thing to really be concerned about is we've been maintaining this sideways range for a week, and the markets are a living thing. I often compare them to nature. There's nothing in nature that you can contain for long periods of time without releasing some of that built up energy, or else it'll just explode. Nothing in nature can be contained without letting out that energy, right? Think of a dam where we dam up water and we still let water out of the dam, right? Because you have to let that energy out. The longer the market stays sideways like this, and we're talking about the indexes, the more it winds up more and more and more energy. You got to think about where all the trades are going, where their hedges are at, where their stops are at, how they are structuring their trade. Now we're just building more and more and more and more right here. When this goes, it's going to be a doozy. There's no promise of direction in this sideways range, right? It's the idea that the longer we're here, the more we are building up energy. And when it goes, oh boy, it's going to go. So I think the range is pretty clear, as it has been just from looking on that higher time frame. Some important levels to mark is where we closed on Friday. You can go out to the daily chart to mark that level just so that there's no disagreement about which close you should mark. the 4 o'clock close, the 4:15 close, the 5 o'clock close. Mark them all, right? Mark any of them, mark all of them. It is very important because when we come back to that level, there will be a reaction in the market. So mark the close of the week. It's not just the close of Friday, right? It's the close of the week. It's a double. Still an institutional pivot point. Another one that will be of concern for today would be the low of Friday. But while you're out there on those higher time frames, just mark the week. Last week's high, last week's low, and last week's close. You could mark all four, open, high, low, close. You could. I don't think it necessarily matters. Those are institutional pivot points, and when we come into contact with those pivot points, there will be a reaction in the market. So you may as well use what we have. Since we're very range bound, you could use the SVE or just pivot. Pivot points will do it just fine. Bring in the pivot points, change it to the week. That purple line is last week's average price. It's the floor pivot for last week. As you can see, we're underneath it. If we are to make contact with it this week, meaning we're going to get that move to the upside, there's very likely going to be a reaction in the market. So you're going to want to know where that pivot is. Generally speaking, I don't like all that junk all over my chart. And what I usually do is use the notepad and I make myself a little bit of a note. And that way, if we're moving towards it, I know where the number is. If we're moving away from it, I know where the number is, right? And I approach a lot of trading from that same perspective. Are we moving towards something or are we moving away from something? Just like last week when we gapped down, where we opened Sunday night is now an institutional pivot point. Every time we get back there, we're expecting a response out of the market. Last Friday's close is a spot that we interacted with last week over and over and over and over again. I had a massive trade that I took last week where I grew an account 1.35%, 135%. It was a $900 account, and by the end of the day, it was a $2,115 account. It was one of my small accounts. In a single day, I grew that account over 100%. And the trade that I took was a rejection from previous Friday's close. We rejected there on multiple days last week. Well, you got the opportunity again this week for the same setup, the same trade. This is the close that I'm talking about. And this is the new week with the new close. So we got the weekly floor pivot. Same thing, you can just load pivot points, leave it on day. There is a trade strategy called the MDP. It's a missed daily pivot. It's a pretty interesting strategy, but every one of the pivot points has books and webinars and strategies connected to them. There's SVE pivots, Persons pivots, Woody's pivots, Camarilla pivots. There's a lot of freaking pivots. Every one of them is designed by somebody who had a particular idea about how to use pivot points with a particular recovery strategy connected to it. Make no mistake about it, guys. This market is not recovering or unrecovering. It's not crashing. It's not climbing. It's not doing good or bad. It's not time to buy the lows. There's nothing to do with this market until the Ukraine conflict changes from its current form. So if you think that buying these lows looks really good, I agree, and I'm buying some of these. I'm buying some of these lows, but only from the perspective that I'm willing to hold it as it continues to go down. Right? You got to be long when the market is short, and you got to be short when the market is long. So if you're not willing to take the pain, you're probably not going to want to try to go long in the market. I did post a really good podcast from Seeking Alpha. It's their weekend podcast, and they crunched the numbers and really looked at the market. And there's nothing good about the current market conditions, right? Not even a little bit. Credit ratings are a really big deal, and one of the things that I've seen repeatedly this morning is downgrades in credit, national uh, downgrades in credit. So there's going to be a significant impact from that. When a company can't borrow cheaply, it greatly impacts those companies. All right, looking at the box. Again, it's getting more and more narrow. This is a 10-day window with a 30-minute time frame. Generally speaking, we usually have a very large box, at least twice the size of the current box. But due to this consistent sideways price action, we're just getting it more and more and more cluster in this one area, right? It's a 100-point range, 43.75 to 42.75, and it's just winding up more and more and more and more. A massive, massive, massive amounts of volume right there. Right there in that 100-point window. Should we break below today's low, the Globex low of this morning, there's no volume to catch us until around 41.75. That's the next volume node with anything even remotely close to a support. So the 75s on the ES seem to really stand out this morning. And don't forget, you have the cog lines at every 11. 42.11, 43.11, 44.11. There is a point of control over our head from yesterday. It's worth dragging that point of control forward if we were to break above our current Globex high. Right, we did have that nice little run to the upside, but it failed to get through the Globex open at the moment. It took a very hard rejection. It's still working it out, but if we do get through there, we've got the close of Friday, and that is really close to the point of control. So you could pretty much just overlap those two pivot points. We just had a significant trend line breakover too, by the way. So now we're going to be looking for some angled support. Starting to build a little bit of a failed flag play. We have 11 days left in this contract. You're going to be, depending on who you use to trade your futures, the M's are going to be next, no matter what, no matter who you trade with. But the way that you want to identify your role is when the M's have more volume than the H. Now, one thing that I generally do is if I see think or swim roll, which it will, that's usually where I go in and I roll my trade of 8, right? That's usually my heads up. But you could just watch the volume every day and look for those M's to start carrying more volume than the H's. But either way, we have 11 days left. So we're getting kind of close. Nobody runs it up to the last day. We'll probably be rolling at some point this week. Wouldn't surprise me. We don't have a market maker move at the moment, but we do have a very wide a very, very wide expected move. $142 from our current location, higher or lower. And I've heard it say and or lower, right? That's usually how it's supposed to be said. So from our current location, we could go 142 points higher and or lower. And there's been weeks where we've certainly done it. Looking at the commitment of traders report and looking at the ES futures, we are in contango where we belong, the way it's supposed to be. But you can see the forward future guidance as running at around 4,800. That's right around Goldman Sachs and JP Morgan's year-end target on the S&P. Right, and you can see that we're looking at next year's levels, June of 2023, getting the S&P back up around 4,800. While we're here, may as well take a look at the VIX. You can see that we're still in backwardation. Um, without a snapshot, it's hard to say how much steeper it is now than it was the other day, but you can add curves and then back it up and see how steep it was on Friday, for an example. It's not a perfect system to do that, but kind of helps you get a gauge of how much things have changed in the volatility level in the skew. So, yeah, as you can see, we're in a squeeze here on the NASDAQ as well. And again, just winding up that price action just tighter and tighter and tighter and tighter. You can see where we had the same situation back here. And then that explosive move out of that range. This was a few weeks ago. We're having the same situation now. When you look at the size of the volatility box last week and then realize that we weren't even really using more than, say, half of that box. So, really wound up, ready to go. The size of the volatility this week is not as big as a change that we saw on the ES, but still bigger than last week. About a quarter, maybe a little less. We are well underneath the weekly floor pivot and we're underneath the daily pivot, but at least we're getting close to the daily pivot. Mark the close of Friday. It's going to be an important level, institutional pivot point. There should very likely be a reaction if we were to get back to that level. We just got back to the open of the Globex, and you could see that reaction just as well. It's not a surprise in that move to the upside that it stopped right at that pivot point. It's why we mark them. It's why they're valuable. It's why we keep track of where they're at. This is also a trend line break, and it is a failed flag setup. Of course, those are reciprocation plays, so we're looking to run it back up to 14,100 or 14,200. We've got an ADR of 3.25%. We're down around 0.75%, so plenty of room on either side. Looking at the volume profile in the NASDAQ, a very, very narrow box between value area high and low, with massive amounts of volume all built up. within that narrow window. It's a 400-point window, and that may sound like a lot, but for the NASDAQ that's been making 100-point candles in a relatively small amount of time, 400 points is nothing. It seems like Germany is pushing against a ban uh, on Russian oil and gas. There's been a number of ceasefire attempts to kind of evacuate citizens. Each side keeps claiming that the other side is violating those ceasefire agreements. It's hard to say. You know, it's all a bunch of finger pointing and he said, she said, and it's not my fault. It's their fault. They broke the agreement. Right now, it looks like there's another one set for 10 a.m. Moscow time. They'll cease fire and hold humanitarian corridors. Maybe. We'll see. Right. So it's all news based today, guys. Did a little deep dive into the sectors over the weekend. Find the chart here. Gonna look a little weird. Okay, on the right, we have the risk off sectors, or on the right, we have FANGs. In the middle is risk off, and on the left is your risk on sectors. So the four indexes: SPYs, Qs, IWM, DIA, financials, technology, communications, IGV, cloud, all of those wrapped up. And then the dollar, the bonds, gold, silver, and Bitcoin. Now, this is a daily graph at the moment. I haven't gone inside of that daily graph, but you could see everything was red except for the dollar, the bonds, gold, silver, and Bitcoin. Go into the risk off environment. Risk off, when you're thinking of the sectors, would be like natural gas, oil, healthcare, utilities, consumer discretionary, in the household, food, staples. So healthcare, natural gas, energy, more energy, industrials, the airlines, not so much. Real estate, metals and mining, consumer discretionary on the in the household, like we were just talking about, marijuana, the S&P growth against the S&P value, and then the VIX. Well, when it comes to the VIX, the VIX is for the SPX. There's the RVX, which is for the Russell, and the VXN, which is for the NASDAQ. And of course, both of those were up as well. Kind of gets us into the FANG names. All of the FANG names were down. Emerging markets, junk, which is your high risk bond, semiconductors. I was looking for an EV market in an ETF. And when you start going down that rabbit hole, you have to start breaking them down into what kind of EV market: the batteries, the self-driving cars, right? And it starts taking tangents in different directions. Hail is about as good as I could identify. VTI, which is like an all-around marketplace ETF. Now, one single day, since these are all three daily charts, would be just focusing on that one single spot, the very last of all of these lines. But if you think about it for the week, then it was 5 days worth of these lines, right? When you start to highlight those for the entire week, you can start to get an idea of how the week went in the overall marketplace within a single page, within a single screen. So from that perspective, small caps in the Russell started to try to turn around. It failed on Friday, but at least that turnaround was starting to come in, as opposed to the other indexes, which never even attempted a turnaround. Growth stayed flat, negative all week, while value started to get a little bit of a turnaround. Metals and mining was solid all week. It never slowed down. It never backed off. Real estate made that significant shift where it had been red for weeks, started to turn around, it even came into the positive. Healthcare, same way, came up off of those negatives into the positives. Utilities, building materials is still getting whacked, but industrials are turning back around. So just a nice little shortcut to everything. Um, we've adjusted the grid so that we've got Bitcoin and gold, bonds, the dollar, the VIX, and oil. Mainly been using these for a war perspective and global hedging, looking to see, where's the money going. It's just about the best snapshot you can get right now, trying to keep an eye on all of the marketplace, especially for an early warning heads up to kind of get the heck out of things, tighten up your stops, reposition. We had 2 trades last week in the SPX, and those 2 trades worked out, reasonably well. They're both day trades, both 0-day trades, and combined ended up getting around $2,100 for those day trades, those 2 trades. And a lot of that bias, or a lot of that perspective, came in from keeping an eye on that grid. No, it's a proprietary indicator, and I can't share it. There's a couple of those that are proprietary that I cannot share. If you want them, you have to go get them. They are from Simpler Trading. So if you just go to the Simpler Trading website and buy it, then you can have it. I made something similar, not knowing that they had that. Mine's not as good as theirs, but it's free. And you would find that in the Thinkorswim workbook. But again, mine is not built the way theirs is. Theirs has like triangles and squares and dashes and circles, which signal different crossover events. Mine doesn't do anything like that. So if you go to the Thinkorswim workbook and run any kind of sector search, somewhere in there, there it is. This is looking at the 11 different sectors, the S&P sectors. And then it has the sector rotation model down at the bottom. If your screen isn't big enough, you won't see all of these, right? But there's the share link. You could just copy the whole code, but you don't need it. These last 7 digits are all that you need. So if you just copy that and paste it into your Thinkorswim, then you'll get something similar to that. But I can't share the proprietary indicators. They're just not mine to share, and I'm not going to get sued. So looking at the sectors this morning, you see we're starting to get that change in capital rotation, but it's still gold, silver, energy, natural gas, oil. The interesting thing is cloud computing is up this morning, and then the rest are, significantly negative. So um, the turnaround play in EEM is looking really good because that's a significant drop to the downside. Mean reversion alone would have me looking to the upside on this one, at least a reasonably decent day trade. Emerging markets is one of those that will do more movement in the overnight hours than it does in the daytime a lot, right? If you go and look back at the chart, the moves in the overnight hours are often much bigger than the candles themselves. I didn't get a chance over the weekend to go to the CBOE website and rebuild the Alpha Protocol list, but it will be done at some point today, hopefully, because it doesn't look like I've got too big of an agenda for the day, which is good. So we'll get that rebuilt. I may end up doing it live. Well, no, wait. I'm streaming in the futures this morning. So no, I won't do it live because I've got the futures, but then after that, I'll get it built. Um, I've already made a video series on how to do it yourself. So if you don't want to wait for me, you can definitely do that. Just go and gather up all the names of the most heavily traded markets in the options market for February, and then just grab the top 100 names on the list and weed it down from there. Once we get through the S&P's 11 sectors, we still need kind of a perspective on sectors that the S&P doesn't have. It's kind of those old school sectors versus the new way of doing things. One of those sectors happens to be crypto. I just made my own list. So it's basically like a crypto index. The names in this list are not crypto names, right? It's not Litecoin and Bitcoin and that sort of thing. It's companies that are heavily invested in blockchain or that own a lot of Bitcoin. This name list comes from Tasty Trades Smalls Exchange Crypto Futures, right? So I didn't make this list. I just copied the names in their list. Mostly down, by the way, which makes sense because Bitcoin's down this morning. EV market, same thing. Just a collection of electric vehicle companies, kind of getting a feel for, if if Tesla's doing good, then usually you're going to see NIO doing good, Ride, Li Auto, kind of peer group. But for the most part, not looking too good over there yet. And the pot stocks, definitely not looking good there. So plenty of names to trade this morning. To me, it's still finance and energy, finance and energy. I am trading tech, but it's more of a day trade in technology than anything else. Not really looking to build any swing positions in those. The swing positions that I've got on, a lot of them are in the TLT or in bonds, a little bit in finance, and then everything else is single contract trades, owning a put or owning a call so that I can sell against them if I need to and hedge off of it. So that's what I got this morning, guys. Be careful, be safe, and I will see you all in the live stream room in the futures.